Hello and welcome to BQ Prime. I'm Hiral Dadia. Four stocks that we will be discussing in today's show. We have CSB Bank, Karnataka Bank, as well as South Indian Bank and Hinzink. Four newsmakers of the day on the back of the business updates that they have come up with and are buzzing in trade today. To decode the same for us, we have Jigar Mistry from Buoyant Capital joining in. Jigar, welcome to the show.
Good morning, Neil. Thank you for inviting me to your show.
Pleasure is always ours, Jigar. Jigar, let's quickly start with the banking pack first. Clearly, when you talk about private lenders from a CSB to a Karnataka bank, or even for that matter, a South Indian bank, the credit growth that they've given out in terms of the Q3 numbers has been pretty strong. Overall, Karnataka Bank, a 12.5% year-on-year loan growth, whereas CSB has seen a 25 to 26% credit growth as well. Simultaneously, if you see in terms of South Indian Bank, the advances have grown around 3.2% on a sequential basis, whereas an 18% year-on-year growth is what we've seen. What do you make of this kind of a loan growth, strong credit growth coming in from these three major banks?
Yes, Hiral. So I think, we have to look at this in perspective of how it has shaped up over the past few years. Right. Initially, the credit growth started improving since 2017 onwards. And then over the past 3 or 4 years, the growth has been driven by two fundamental categories. The first is retail and second is the government borrowing. Right. The corporate sector borrowing has not really been picking up as fast as one would have liked. But that, is following something that happened in 2015 and how, a lot of corporates are a lot debt averse. Looking at the past 1 year or so, we have seen two trends developing. First, clearly the credit growth has been surpassing most estimates, month over month. But more interestingly and more recently, the deposit growth has not really been sort of picking up, right? So the deposit growth minus the credit growth is at almost a 2-decade low, which will force a few of the larger excuse me, few of a larger banks to basically calibrate on how fast do they want to grow. And therefore, you initially seen actions move on to say something like an ICICI bank or an Axis bank. Those are the businesses we do own. Then to something like an SBI and to private and public sector banks. And then, onto the, these much smaller banks, which are of this 4.5, 5,000 crore market cap bracket, where the optical number looks fairly strong because they are coming off a much slower base. And the valuations, if you look at, Karnataka or the South Indian Bank, then they are trading even now well below book, right? CSB is slightly around 2 times price to book. But that is a very deadly cocktail, right? Because one, you have the credit growth which is coming through. Two, post 2015, the AQR done by Raghuram Rajan and how the banking sector balance sheets have been cleaned up. You are seeing that most credit growth, the banking books are so clean, and then the credit growth being driven by retail leaves a lot of impetus for the smaller banks to keep expanding. Historically, you would have seen that a rising interest rate cycle brings along with it a rising non-performing asset cycle as well. And, investors used to get worried. But this time around, we have to make a separate trend because essentially the growth is driven by retail. And it's unlikely that the entire retail book will go for a toss, at the time when, interest rates are rising. And let me sort of pinpoint a small trivia here. If you look at the past 10 years, the SBI's retail delinquency, State Bank of India's retail delinquencies are lower than HDFC Bank and ICICI Bank also. Right? So now if you are in this environment where credit growth is strong, NPA cycle is not likely to rise, you keep going down the curve in terms of where the, valuations versus the growth paradigm resides. And therefore, you get to the smaller banks. Yeah.
Right. So from a smaller bank perspective as well, if you see there is some bit of moderation that is coming in with regards to deposit as well as CASA. So do you think the smaller banks probably are an exception and there is a larger trend of pressure in garnering deposits from here on?
I would think so, Hiral, because see, your credit growth minus the deposit growth is at a minus 8.8%. And as I said, that's a 2-decade low. Right now, what will need to happen? Now, think of this scenario that if you are unable to find deposits to fund your credit, then banks that are sitting on excess SLR will have to come down and sell those to fund the credit growth. Now, if they go ahead and do that, your yields will spike at the time. You're looking at almost 17, 18 lakh crores of government borrowing over a year and a half or so. So RBI, instead of monitoring the FX situation, and we have lost something like $80 billion in forex reserves, will have to come down, sterilize the domestic liquidity through OMO, and that becomes another problem altogether. So I think the best way is to find the deposit growth to grow, in absence of which the larger banks might want to take a foot off the pedal a little bit, which allows a lot of the smaller banks. See, push comes to shove, these are rounding off errors for the growth that that a CSB does or a South India bank does is a rounding off error in the overall SBI balance sheets, right? And therefore, when you say 25%, the incremental market share of that deposit growth is so minuscule that in the overall scheme of things, it doesn't really move the needle much. But for that particular bank, it's a 25% growth coming on the back of valuations which are much more attractive. Mind you, other than CSB, none of the other two banks, even on the past year, have been reporting ROEs which are higher than 12%. So I could argue that, look, why even give them one-time book? But the fact of the matter is that a lot of these banks have reported September quarter numbers, which are much higher than their half year of previous year, and maybe more than the entire 2020 profitability. So sorry, please go ahead.
Yeah, go on.
So the calibrated approach is this, that look, at a certain point in time, all of us have generated tremendous alpha of the large private sector banks. Now there is a call. The call is whether you want to, and for a lot of us, that was not even a duration call, right? Now the call is that which is the bank that offers me the cleanest see-through into their books, right? And there was a point in time when SBI was at 0.3 times book, and I didn't really need to have a see-through into their credit history, because eventually they were going to 1% ROA or 17, 18% ROE. But now there comes a time when you have to sort of look at which banks offers you the cleanest ROA at the time when interest rates are rising and deposit growth is slowing down. And as a firm, therefore, we have to continue to remain with the larger banks. But this smaller retail banks will continue to show some amount of growth that will lead to some amount of re-rating. Arguably, one-time book is good enough for South India and Karnataka, and 2 times for CSB. I can get Axis Bank at similar valuations, or IndusInd, and I could play a CV cycle or a wholesale book respectively. But the growth will be faster definitely for a lot of these smaller banks.
Right. So overall, if you have to look at the 3 banks that we're talking about, South Indian, Karnataka, and CSB, and let's put that into perspective that one, yes, there will be a push with regards to deposit rates because it is year end and usually it's a busy season for credits too. So a tougher race on that front. Secondly, on net interest margins as well, it is widely expected to peak because the liquidity situation is also tighter for most banks, and the liquidity coverage ratio is now close to almost 100% for banks. So they cannot really go below the 100% mark. And lastly, if you go to see clearly any small deviation you will see on any of these fronts, there could be a bad situation that could come in. So overall, what would your call be on these 3 banks versus the larger names that you mentioned? Do you think this would be a good time for someone to buy any of these 3 stocks?
Remains to be seen here. So, look, in a rising interest rate scenario, banks tend to reprice their assets much faster than their liabilities, right? Your home loan rates go up immediately, and your deposit rates are very low to be increased. In that scenario, NIMs typically expand for banks, and therefore the value of you do incur some amount of loss in your GSEC portfolio, but that doesn't carry a P, right? Your NIMs carry valuation multiples, and therefore the value of the bank or the asset typically increases. In that scenario, my sense is that banks are in a very, very sweet spot. CY22 was driven by financials earning. They accounted for almost 50% of incremental Nifty profits. that scenario will likely continue. And in event that we are not likely to see a contagion sort of in terms of NPA cycle coming back in a hurry, then it might continue. The banks that grow faster might continue to surprise us on the positive, and they might not really have a large bit of this, deposit crunch that the larger banks will likely see. And therefore, one could prefer to stay, into the banks that we did discuss. Although as a fund, we find it very difficult to, operate into this sub $1 billion banking structure from two reasons. One, liquidity of shares on the indices are not that abundant. And secondly, there is no clear look through into how, difficult cycles operate. I don't really know,
Right.
how the cycle is going to pan out. So as a fund, we have chosen not to. But as a sweet spot, I can definitely find the allure on why that makes an interesting bet for someone who does own it.
Right. And moving from the banking space, another stock that's buzzing is with regards to Hind Zinc. Clearly, if you see in terms of the mined metal production, that has seen a growth of around 1% on a year-on-year basis. However, refined metal has been down. Zinc has seen a marginal degrowth. Lead has seen a degrowth. And silver has seen a degrowth as well on a year-on-year basis. But however, are you seeing there is light at the end of the tunnel now for the metal space, taking into consideration the global metal demand outlook now? China has opened up. If you see from a pricing perspective as well, it seems that it's bottomed out. So how are you seeing the metal space, and specifically a Hind Zinc? What would your call be?
Right, it's a very interesting company. I've been to their plants a few times. The Rampura Gucha mine, which is the world's largest sort of mine, is like a 3 kilometer by 2 kilometer mine. Very beautiful. The company has grown dramatically over the past 2 decades that I have looked at them very keenly. But here what tends to happen is that all these stocks don't really move on the earnings or valuations as much as they move on the commodity prices per se, right? And commodity prices are listed on the London Metals Exchange, and they are as much a slave to USD INR movements or USD to other economies movements that you keep seeing the pressure of this withdrawal of liquidity by the central banks. Now, if I look at my 2023 outlook, my base case scenario is that we are likely to see some amount of pullback continuing. What was $1 trillion has gone to 9 over the past 24 years or so with the Federal Reserve. And when they pull back some of that liquidity, all risky asset class, which includes emerging markets as well as commodities, will likely bear the brunt of it. If that were to transpire, then anything that is listed on any exchange, including a London Metals Exchange, will likely see a drawdown in prices. Now you have to juxtapose that to the fact that your China is now reopening, and to that end, your demand will increase at the time when US dollar, etc., will likely play a little bit of a spoil sport. Within the complex, Hindustan Zinc again remains one of these lowest cost producers in the world. And there, if LME prices were to crack and and Hindustan Zinc prices were to come down a little bit, it would definitely be among the more interesting metal stocks in India to keep on the radar. Again, liquidity is a big issue because I think Vedanta owns 65%, government owns 29%, LIC owns. So the free float is so low that funds find it extremely difficult to get in and out of this name, but it is definitely one of the best run companies in India, both from operations and capital market perspective.
Right. And any upside that you would recommend on the stock?
Not from this level. So we don't own it. Obviously, we don't recommend stocks to anybody. We don't have a license to do that. We can buy and sell as the fund that we run, but we don't own this name here. But there could be, see, after the initial first 3 or 4 months when we will fully see the withdrawal symptoms of liquidity being withdrawn, I think there could be an interesting time to get into the metals complex rather than just buying it on the China upside.
Right. So overall, the 4 stocks that we've discussed today as well, Jigar, seems to be that all the 4 do remain in a sweet spot as we speak right now. But yes, there is going to be a fight in terms of how the deposit rates actually pan out and how they're able to garner deposits between the biggies, and how the small banks actually keep up to that pace. And from the metal space, as well as Jigar mentioned, that yes, China opening up is going to be a positive overall, and the timing is something that we need to wait and watch. Thank you, Jigar. Thank you so much for joining us on the show. It was a pleasure speaking to you. Thank you for sharing your views as well. Speak to you soon again and stay safe.
You too. Likewise. Thank you, Hiral.